we're diving into one of the most influential books in personal investing, A Random Walk Down Wall Street by Burton Malkiel. In this deep dive, we'll explore the key ideas from Chapter 5. Now, if you've ever paid even a little attention to the financial markets, it's clear Wall Street truly is the biggest game in town. We're talking, hundreds of billions, even trillions of dollars changing hands daily. Stocks, futures, options.
Yeah.
It's huge. And where the stakes are this high, well, the rewards for those at the top can be absolutely immense. A fresh MBA from a top school, they might pull in a couple $100,000 a year. But the top money managers, often making millions, sometimes hundreds of millions.
The compensation is certainly staggering, isn't it? What's fascinating, though, is that despite these huge earnings for professionals, there's this strong academic viewpoint. It often questions how much true value they actually add. This perspective often points towards the efficient market hypothesis.
Right, the idea that everything's already priced in.
Exactly. Simply put, it suggests all available information gets reflected in stock prices almost instantly. So, you might do just as well, maybe even better, just holding a broad market index fund.
So if the market might just price everything efficiently on its own almost instantly, why do investors still put so much effort into trying to predict stock prices? This intense quest, to time buys and sells, it's led to an incredible variety of forecasting methods.
Oh, definitely. Some are, truly.
Yeah.
Well, out there, you hear about people looking at sunspots or moon phases for market signals.
Really? Sunspots?
Yeah, strange stuff. But most investors typically lean into one of two main approaches: technical analysis or fundamental analysis.
Okay.
And those two approaches, they fundamentally tie back to different theories of how stocks actually get their value. Technical analysis, for instance, it really resonates with the castle in the air theory.
Castle in the air, meaning it's about what others think it's worth.
Precisely. Value is primarily about what others are willing to pay. It's about the psychology of the crowd. Fundamental analysis, on the other hand, that's firmly rooted in the firm foundation theory.
Firm foundation, so finding the real worth.
Exactly. Aiming to discover a stock's intrinsic underlying value.
Okay, let's unpack the first one then.
Yeah.
The world of technical analysis, the chartists. What exactly are they trying to do?
Right. So technical analysis is essentially the art, or maybe science, of interpreting stock charts. These practitioners, they meticulously study past price movements and trading volumes. They're looking for clues, patterns, anything really that can hint at where prices are headed next.
Okay.
Their core belief is that only a small percentage of the market operates logically. The vast majority, they argue, is driven purely by psychology.
Psychology. So it's a game then.
Very much so. It's seen as a game of anticipating what other players will do, focusing on the market's mood, not necessarily the company's, actual business.
So if I'm a chartist, I'm basically ignoring the company's financials, its balance sheet, and just focusing on the chart. That sounds incredibly speculative.
It can seem that way. How do they justify it? Well, their core belief is that the market's collective wisdom, or maybe its collective emotion, is already baked into the price.
Baked in.
Yeah. They'd argue that focusing on external news, like earnings reports or whatever, is just a distraction. They operate on two main principles. First, they believe that all relevant company information, earnings, dividends, future performance, you name it, is already reflected in past stock prices and trading volumes.
All of it.
That's the claim. They see fundamental data as either irrelevant or, like I said, already priced in. There's a classic anecdote about an early chartist, John McGee. Apparently, he boarded up his office windows to avoid outside distractions.
No way. Just him in the charts.
Exactly.
Yeah.
He believed looking at anything else would just mess with his analysis. Pure focus on the price action.
Wow, that's dedication. Okay, and their second principle?
That stock prices move in persistent trends. They believe this strongly. They construct these charts, marking a vertical line for each day, showing the high, the low, and a little tick for the closing price. And below that, usually a vertical line for trading volume.
Right.
As these daily lines accumulate, they start to form patterns. Chartists see these patterns like an X-ray for a surgeon, revealing the underlying market dynamics, they'd say.
Okay, so once they've got these charts, these patterns, what are the specific signals they're hunting for? What tells them buy or sell?
Well, they're looking for several things. First, those persistent trends we mentioned, like a clear uptrend. You can often connect the low points to form an upward trending channel. The core belief is that trends, once established, tend to continue.
Okay, inertia.
Kind of, yeah. But then you also have resistance levels. These are price points where a stock seems to struggle to break higher, like it hits a ceiling.
Right.
And then there's the really famous one, the head and shoulders top formation.
Right.
That's seen as a clear sell
Oh,
signal.
shoulders, like the shampoo.
Brief chuckle sound, implied, not written, sort of. The price makes a peak, a shoulder, then a higher peak, the head, then another lower peak, the second shoulder. Once the price falls below the neckline, that's a line connecting the lows between the head and shoulders, it's considered a definitive sign to sell.
A broken neckline means get out.
That's the idea. Though, of course, sometimes the market throws a curveball, a bearish signal might fail, and the price goes up instead. They call it a bear trap, an exception.
It sounds like a very short-term game then. They're not looking to buy and hold for years, are they?
Not at all. Chartists are definitely short-term traders,
Yeah.
very much in the moment. They buy when the charts look favorable, and they sell, often very quickly, when ominous signs appear. It's
Right.
all about quick in-and-out trades, not long-term commitment to a company.
Quick flips based on patterns.
Exactly. And actually, it's interesting, their vocabulary. Terms
Yeah.
like double bottoms, breakouts, buying climaxes. Some psychiatrists have even noted that some of this terminology carries, well, sexually suggestive undertones.
Really, buying climaxes. That's descriptive. Suggests a lot of emotion, maybe.
Perhaps. It hints at the almost visceral, emotional investment in these quick moves, where the timing feels like everything, like catching the perfect wave.
Okay, so if it seems so driven by maybe emotion or at least market psychology and kind of abstract, why do chartists believe this method actually works consistently, especially when it's supposed to be a rational market?
Well, they'd argue it taps into genuine market dynamics, things that are real. Take the herd instinct, for example. When a stock starts moving up, it's just human nature for others to jump on board, right? Chasing that momentum.
FOMO, fear of missing out.
Exactly. Chartists argue they're simply observing and profiting from that undeniable human tendency. It can become a self-fulfilling prophecy. The rising price itself generates more buying interest.
Yeah.
Another idea is unequal access to information.
Ah, like insider trading.
Well, not necessarily illegal insider trading, but just how information spreads. When good news comes out, maybe company insiders know first and start buying, pushing the price up a bit. Then maybe their friends find out, then the professionals, and finally the general public gets the news. This gradual diffusion of information could create trends that chartists pick up on, like sniffing out where the smart money is moving before everyone else does. Think about cases like ImClone systems back in the day, where some insiders allegedly benefited from non-public info. That kind of gradual spread could show up as a trend on a chart.
Okay, that makes some sense. And what about investor psychology regarding past prices? Does that play a role?
They think so, yeah. Chartists point to how investors remember their past buying prices. Say you bought a stock at $50 and it drops to $40. If it rallies back up to $50, a lot of investors might be really eager to sell, just to break even and get out.
Get their money back. Relief selling.
Exactly. So that makes $50 a potential resistance area or ceiling. Similarly, maybe a stock was at $40, ran up to $60, then pulls back to $40. Investors who missed buying it at $40 the first time might see this as their second chance and jump in. That makes $40 a support level, like a floor. The charts, they argue, simply reflect these predictable psychological responses.
Those are interesting rationales. It paints a picture of the market driven by memory and emotion. But what are the main arguments against relying purely on technical analysis?
Well, the biggest criticism is probably that technical signals often lag. They're based on past data. By the time a trend or a pattern becomes really clear and obvious on a chart, the significant price move might have already happened.
So you're always reacting, not predicting.
In a way, yeah. Chartists can kind of miss the boat because they're acting on what has occurred, not necessarily what's about to occur. The signal confirms the move after it's underway.
And what about the idea that if everyone uses the same signal, it stops working?
That's another big one. It can be self-defeating. If a particular technical trick or pattern becomes widely known and everyone tries to act on it at the same time, well, its predictive value evaporates pretty quickly. Everyone rushes for the exit or the entrance simultaneously.
Makes sense. The edge disappears.
Right. And perhaps the most powerful argument against it, coming back to what we discussed earlier, is market efficiency itself. If the market really is highly efficient, then any truly valuable new piece of information, let's say a company's chief chemist discovers a revolutionary new process that could double earnings. The the stock price wouldn't just gradually trend up for chartists to spot. It would adjust almost instantly to reflect that new reality.
Bang! Price jumps immediately.
Pretty much. As soon as the word gets out, institutional investors, smart money, they'd pile in or out so quickly.
Yeah.
The Malkiel book puts it nicely. The show is over before the chartist even gets on stage.
It certainly sounds like a tough way to consistently make money then. Yet technical analysis clearly still has a lot of followers, maybe even more now with technology.
Absolutely. Before computers, chartists were often seen as kind of eccentric, hunched-over graph paper plotting manually. Today, with computers, they've morphed into technical analysts. It sounds more sophisticated, maybe. And they have instant access to hundreds of indicators, far beyond what anyone could chart by hand. Moving averages, RSI, MACD, Bollinger Bands, so much data.
A whole toolkit.
An entire digital playground of data. But the fundamental challenge, the criticism about lagging signals and efficiency, that still remains.
Okay, so if the chartists are trying to predict these market mood swings, often reacting after the fact, sounds like a real challenge, as you say, to consistently win this game. What's the alternative? The other main approach you mentioned. Let's switch gears to fundamental analysis. This feels like it should be much more, well, grounded, almost the opposite.
It really is, in philosophy at least. Fundamental analysis is all about determining a stock's intrinsic value, its firm foundation value. It's about figuring out what a stock is actually worth based on the company itself, separate from the market's often volatile optimism or pessimism.
So digging into the company's real business.
Exactly. There's a great anecdote from Fred Schwed Jr. about a broker selling a stock way above the current market price. When the client complained, the broker supposedly scoffed, "You people don't understand. When we select investments, we do it based on value, not price." That really captures the fundamentalist mindset. Value over fleeting price.
Okay, so while chartists see, 90% of the market as psychological,
Right.
fundamentalists would probably argue 90% is logical, or should be. What's the core job of a fundamental analyst then? What are they actually doing?
Their most important task, really the heart of it, is to estimate a company's future streams of earnings and dividends. That's what ultimately drives value. And this isn't just, pulling numbers out of thin air. It involves deep research.
Like what kind of research?
Oh, everything. Sales forecasts, operating costs, tax rates, debt levels, the company's capital structure. They'll often visit management teams, talk to suppliers, customers, competitors. Benjamin Graham, a huge influence in this field, called analysts prophets without divine inspiration. They have to rely on meticulous study, not magic. They usually start by analyzing the whole industry outlook, then dive deep into individual companies within that industry, hoping to uncover factors the market hasn't fully appreciated yet.
Trying to find that hidden value. And what are the key factors they focus on to determine this proper value?
There are generally 4 fundamental determinants they look at. The first, and arguably most important, is the expected growth rate.
Growth. Okay.
Yeah, future growth in earnings and dividends.
Right.
And most people really underestimate the sheer power of compound growth over time. Albert Einstein supposedly called compound interest the greatest mathematical discovery of all time, or maybe the 8th wonder of the world, something like that.
Strong words.
Because compound growth means your initial investment and the returns you earn on that investment both start earning further returns. It's this exponential engine of long-term wealth. Think about that story of Manhattan Island. If the $24 paid for it in 1626 had been invested at, say, 6% interest.
It would be worth billions today, right?
Over $100 billion,
Yeah.
easily. It illustrates the incredible power of long-term compounding.
And that reminds me of the rule of 72, that quick way to estimate doubling time.
Exactly. A great mental shortcut. Divide 72 by the annual interest rate to get the approximate number of years it takes for your money to double. So at 6%, it doubles in about 12 years. 726 is 8%. It's 9 years. It just underscores this exponential power. But, and this is a huge but for investors, sustained high growth is incredibly hard for companies to maintain.
Why is that?
Well, think about percentages. A small startup adding $1 million in sales might be 100% growth. That's amazing. But for a giant corporation like Apple or Microsoft, adding that same $1 million is, well, it's a rounding error. It's much harder to maintain a high percentage growth rate as the base gets bigger and bigger. Competition increases, markets mature. It's like population growth. You can't just extrapolate high rates forever. The book uses a funny example. If California kept growing faster than the U.S., eventually like 120% of Americans would live in California.
Chuckles implied. Clearly impossible.
Right. So the first rule for fundamentalists is, Rule 1, a higher expected growth rate for dividends and earnings justifies a higher price a rational investor should pay. And the corollary is, The longer that period of supernormal, above-average growth is expected to last, the higher the justifiable price.
Okay. And this expected growth, this often shows up in a stock's price to earnings ratio, the PE ratio, right?
Yeah.
So when we see a high PE, what's that really telling us?
It's essentially the market's shorthand forecast for future growth. A higher PE means investors are willing to pay more for each dollar of current earnings because they're betting on significantly higher earnings in the future. So the key insight for you, the listener, is this. Look at that PE ratio. If it's way higher than the company's historical average or its competitors, especially if the growth rate doesn't seem to justify it. Like the book mentions General Electric at one point having a PE of 20 when maybe 18 was average for its growth rate. You might be paying for excessive optimism. Overpaying for growth is a classic trap.
Got it. Price relative to expected growth. What's the second determinant?
The second one is the expected dividend payout ratio. How much of its earnings does the company pay out to shareholders as dividends? All else being equal, Rule 2 says, a higher proportion of earnings paid out as dividends generally makes a stock more valuable. Investors like getting that cash.
But wait, don't high-growth companies often reinvest their earnings instead of paying dividends?
Exactly. That's the nuance. A high payout ratio might actually signal low future growth prospects because the company doesn't see great reinvestment opportunities. And many fast-growing companies, especially in tech, prefer to retain earnings or use cash for share buybacks rather than paying dividends, aiming for higher future growth that way. But comparing two companies with similar growth outlooks, if one pays out a larger chunk of its earnings as dividends, fundamental theory says it should be valued a bit higher. Okay, makes sense. And risk must play a role too, I imagine. Absolutely. That's the third determinant, the degree of risk. Risk is inherent in investing, and it definitely impacts valuation. Investors are generally risk-averse. They prefer lower risk for the same expected return, which is why stable blue-chip companies often command higher PE ratios than more volatile ones. Now, measuring risk precisely is notoriously difficult, but one common way is to look at a stock's price volatility compared to the overall market.
Like beta.
Beta is one measure, yeah. Or just looking at historical swings. For example, Johnson & Johnson is known for its stability. If the market drops 20%, maybe J&J only drops 10%. A more volatile stock, say Salesforce.com as the book mentions, might plunge 30% or more in that same market drop. So Rule 3 states, the lower a company's perceived stock risk, the higher the price a rational investor would be willing to pay, all else equal. The takeaway for you is to understand your own risk tolerance and look for companies whose risk profile aligns with what you're comfortable with, because risk directly impacts value.
Right. Stability is valuable. That brings us to the fourth determinant.
The fourth one is the level of market interest rates. This is crucial. The stock market doesn't exist in a vacuum. Investors always have alternatives, right? Like bonds, real estate, even just cash in the bank. If interest rates are really high, like they were in the early 1980s when you could get almost 15% on corporate bonds.
Wow, 15%.
Yeah. Capital naturally flows out of relatively riskier stocks and into safer bonds offering those high yields. That tends to drive stock prices down. Stocks essentially have to become discounted goods to compete.
Yeah.
Conversely, if interest rates are very low, like they have been for much the last decade or so, bonds look less attractive and stocks become relatively more appealing. This tends to push stock prices higher. So Rule 4 is lower market interest rates generally lead to higher stock prices. What this means for you is that the broader economic environment, especially what the central bank is doing with interest rates, can significantly influence the entire market's valuation level, not just individual stocks.
Okay, so growth, dividends, risk, and interest rates. These four rules sound like a pretty solid framework for figuring out a stock's value, but I suspect it's not quite that simple in practice. What are the big buts or caveats?
You're absolutely right. It sounds straightforward, but applying it is tricky. There are three really crucial caveats with fundamental analysis. Caveat number 1, expectations about the future cannot be proven in the present. This is huge. All that forecasting of future earnings and dividends, it's inherently uncertain, it's risky. Just think about the extreme optimism during the dot-com bubble versus the profound pessimism during the 2008 financial crisis. The same companies might be viewed completely differently depending on the prevailing mood.
So sentiment still creeps in even when you're trying to be objective.
It inevitably does. Future prospects are filtered through the lens of current optimism or pessimism. And even the experts get it wrong all the time. As Samuel Goldwyn famously quipped, it's tough to make predictions, especially about the future. So the core lesson here is, any fundamental valuation is only as good as its underlying assumptions about an uncertain future. Garbage in, garbage out potential.
Okay, future uncertainty is unavoidable. What's the second caveat?
The second one is that it's impossible to obtain a precise value using uncertain information. This is where analysts can sometimes, well, fool themselves or others. You might do all your careful research, run your models, calculate a stock's fair value, and find it's actually lower than the current market price.
Meaning it's overpriced.
Right. But instead of concluding it's overpriced, an analyst under pressure, or maybe one who's already bullish, might be tempted to just tweak the assumptions a little bit. For example, maybe they assumed high growth for 10 years. What if they expand that high growth period to 11 years in the model?
Just nudge the inputs.
Exactly. And because of compounding, extending that growth period even slightly can significantly increase the calculated fair value, maybe enough to make the stock look attractive after all. You can basically manipulate the inputs to justify almost any valuation you want, within reason. The hard truth is, determining a stock's precise intrinsic value is impossible. There's a memorable quote in the book. The Almighty God does not know what the appropriate P/E ratio for a common stock should be.
Wow. That puts it bluntly. Even God doesn't know the right PE.
It highlights that even fundamental analysis has a significant subjective element. A truly precise objective value is probably an illusion.
Okay, that's a powerful statement about the subjectivity. And the third caveat.
The third one is that the market's valuation of growth itself changes over time. We know the market values growth, and higher growth rates generally lead to higher P/E ratios. But the premium investors are willing to pay for that growth isn't constant. It fluctuates wildly.
Like fashions change.
Kinda, yeah. In the early 1960s, the go-go years, growth stocks commanded extremely high P/E ratios. People paid huge premiums. Then, during the dot-com bubble in the late 90s, early 2000s, some tech stocks had P/E ratios in the hundreds, astronomical levels. And we all know how that ended painful lessons for investors when those bubbles burst. So relying on historical P/E ratios as some kind of fixed standard for what growth is worth can be really dangerous, because market sentiment shifts dramatically over time. Think tulip bulb mania.
Right, the market's appetite for growth isn't stable.
Exactly. The key takeaway for you, the investor, is that what the market is willing to pay a premium for today might not be what it values tomorrow. Chasing the hottest, most expensive growth story can lead to significant losses when sentiment shifts.
Okay, so it really sounds like neither pure technical analysis nor pure fundamental analysis is a guaranteed path to investment success. They both have pretty significant drawbacks. But do analysts or investors ever try to combine them, maybe get the best of both worlds?
Many do, yes. It's quite common to try and blend the approaches, leveraging the strengths of both while trying to mitigate their individual weaknesses. The book suggests 3 sensible rules for potentially combining them. Rule number 1. Only buy companies whose earnings growth is expected to exceed the market average for more than 5 consecutive years.
Focus on sustained, exceptional growth.
Exactly. Exceptional, long-term earnings growth is probably the single most important factor for major investment success over time. Because when a company's earnings grow rapidly and consistently, its stock price can benefit in 2 ways. First, obviously, from the higher earnings themselves. But second, the market might recognize this superior growth and award the stock a higher P/E ratio. It gets re-rated upwards. This gives you a powerful double benefit.
Earnings go up and the multiple the market pays for those earnings goes up too.
Precisely. The book gives an example where a stock might triple from $7.50 to $30, not just because earnings grew, but because its P/E ratio also expanded significantly as the market appreciated its growth.
That sounds like the sweet spot. What's the second combined rule?
Rule number 2. Never pay more for a stock than its firm foundation value, even for great growth companies. Now, we just discussed how finding a precise intrinsic value is impossible, right?
Yeah, God doesn't know the PE.
Exactly. But you can still use benchmarks. A simple one is the overall market's P/E ratio. Look for these potential long-term growth stocks, but try to buy them when their P/E ratios are at, or maybe not much higher than, the average P/E for the market as a whole. Peter Lynch, the legendary manager of the Magellan Fund, famously used a similar idea, looking at the P/E ratio relative to the growth rate, the PEG ratio.
Keep the price reasonable, even for growth.
Right. If you buy a good growth stock at a reasonable P/E, and that growth actually materializes, you stand to get that double benefit we talked about. But if you overpay wildly for growth that's already widely recognized and reflected in a super high P/E, you risk a nasty double whammy if that growth slows down even a little bit.
Double whammy.
Yeah, both the earnings growth might disappoint and the market might slash that high P/E ratio is willing to pay. The stock price can crater. The message is clear. Even for great companies, the price you pay matters immensely.
Okay, find long-term growth, but don't overpay. What's the third combined rule?
The third rule tries to incorporate the psychological element. Look for stocks whose growth story is one that investors are likely to build castles in the air upon, but make sure those castles rest on a firm foundation.
So solid fundamentals plus a story that captures the imagination.
Exactly. This rule acknowledges that the market isn't purely logical. Investors are emotional beings driven by greed, hope, fear, narrative. A company might have solid, maybe just average growth, but if it has a really compelling story, a new technology, a charismatic CEO, a product everyone's talking about it, can maintain a high PE ratio for a long time just because it generates good feelings and captures the public's imagination. People want to believe the story.
So you want that firm foundation of value, but also something that taps into market sentiment, potentially creating a positive feedback loop.
That's the idea. You want the solid fundamentals first, the firm foundation. But then, ideally, you find one with a narrative that allows other investors to build their psychological castles in the air on top of it. A technical analyst might then come in and use their charts here. They might look for an uptrend or other bullish signals to confirm that, yes, this investment story is actually gaining favor with the public, that the castle building is underway.
Interesting. So it's about combining the numbers with the narrative, the logic, with the psychology.
It's an attempt to do that, yes, but it also serves as a clear reminder, even with these combined rules, that consistently winning in this investing game is incredibly challenging. There's no magic formula.
Wow, what a deep dive into the real complexities of trying to value stocks and forecast where prices are going. It's really clear that both technical and fundamental analysis, while they're the main tools people use, they both have significant strengths, but also some really significant weaknesses.
Absolutely. And given those inherent difficulties, the challenge in precisely valuing companies, the unpredictable nature of market sentiment and psychology, it really raises a critical question for you, the listener. What does it truly mean to be a smart investor in a world where fundamental values seem elusive and market sentiment can just shift so dramatically, sometimes overnight?
That's a great provocative thought to leave everyone with. What does being smart even mean here? And for those of you wondering, how much faith should we put in all this analysis, technical or fundamental? Well, our next deep dives will actually dig into the real-world performance records. We'll look at how these approaches have actually fared over time to assess how much trust one should really place in professional investment advice. You won't want to miss that.
If you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.